Jerome Powell just finished being interviewed at the Economic Club of Washington, D.C. And as I'm watching this interview, taking notes of what he's saying, you saw the stock market begin to rally. Why? Because of what he said about inflation and interest rates and what might be coming in 2023 and 2024. So let me start by talking about what Jerome Powell said, because the first question that he was asked had to do with this whole idea of disinflation. Because in his last meeting, when Jerome Powell and the Fed raised interest rates by 0.25% in their most recent meeting in February of 2023, he talked about this whole idea of us starting to see disinflation, which created a lot of confusion. What is that? And he clarified that today by saying disinflation means that we're finally starting to see inflation come down. We're finally starting to beat inflation, and we're finally starting to see inflation come down to a more reasonable level. Now, he did say that inflation has a long way to go, that there's still a long fight ahead to bring inflation down to the 2% target. But he said the process of beginning to see inflation go down has begun. That's what he meant by disinflation. The way he said it is that the disinflation process, the process of getting inflation down, has begun. And then he was asked, when are we going to see 2% inflation? Well, he said that we expect 2023 to be a year of significant declines in inflation, and that in 2024 we can expect inflation to come back down to 2%. Now, you can start to see where there's dissenting opinions here, because Jerome Powell and the Federal Reserve Bank are saying that inflation will be back down to 2% in 2024. And then you have other people like Michael Burry who are saying the complete opposite. Michael Burry is saying, well, right now we're seeing inflation go down, but as we start to see more pain in the economy and that comes more to surface, then the Federal Reserve Bank will be forced to stimulate, cut interest rates, and that will force inflation to go even higher in 2024 and potentially create even bigger highs of inflation in 2024. So you have some people like Michael Burry saying inflation is going to break new highs in 2024, while Jerome Powell is saying inflation is going to come down to the 2% target in 2024. Then he was asked, why is 2% the target? Why is it not 3% or something else? And what Jerome Powell said is that 2% is the global standard, and that he does not expect to change that 2% target, and there's no wiggle room there. So that's why he said 2% as opposed to 3% and not 0% or anything else. But the interesting thing, though, is where Jerome Powell was beginning to talk about how aggressively they will now work to increase interest rates to bring inflation down, because they've already slowed down how aggressively they're raising interest rates. In 2022, it was from 0.75% to 0.5%. Now we're at 0.2%. And what he said is that the Federal Reserve Bank is going to look at the data. They're going to look at the inflation numbers, they're going to look at the economic numbers, and they're also going to look at the jobs numbers. And based off of what this data says, they're then going to discuss and influence how fast they increase interest rates. And while the jobs numbers, you might think it's good news. We added 500,000 some jobs in January when we were expected to add 100,000 jobs. What he's saying is that also gives rise to concern, because when you have all this demand for jobs and people are getting all these jobs, unemployment levels go down, well, that can also push wages a lot higher, which can contribute to higher inflation. So what he's saying is that we need to see slower wage growth to cool down inflation. Now, he did say that wage growth has cooled now since 2022 levels, but he wants to see further wage growth cooling and potentially even a bigger slowdown in the labor market, meaning more layoffs, because that would then contribute to less inflation. Why? Because, well, inflation has to do with demand. When more people are buying things, like if more people want to buy homes, that pushes home prices up. And this brought us to the probably most interesting part of the interview, which was what caused this inflation in the first place? Because the interviewer asked Jerome Powell, why do we have all this inflation? Now, we've been covering all this in Market Briefs, which is my free financial newsletter, which is why if you haven't joined Market Briefs yet, make sure you do that. It's a super simple and easy way for you to stay up to date on what's happening in the financial markets into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. But when Jerome Powell was asked why we have this inflation, he responded by saying it's clear and evident that the pandemic shutdown of the economy and then opening up of the economy is the cause of inflation. He had a little bit of silence as soon as he said that, and then the interviewer followed up by asking, well, what's the balance sheet of the Federal Reserve Bank? And Jerome Powell said $8.4 trillion. That caused a little bit of, you could see a little bit of tension as soon as he said that. But then Jerome Powell went on to kind of talk about how it wasn't money spending, money printing that caused inflation, it was the economic shutdown. Then they changed topics, and then towards the end of the interview, Jerome Powell came back to this topic and then emphasized that the reason why we have this inflation today isn't due to monetary policy, it's due to supply chains collapsing during the pandemic. Now, this is where I really want to emphasize and talk about this for a second, because if you really understand the way inflation works and is created, it'll help you understand where inflation is going. Because when 2020, the pandemic hit and the economy was shut down, which meant nothing was being produced. Clothes weren't being made, things were not being produced. But then we also opened up the money printer. Because at first, when everything was shut down, people didn't have money and nothing was being produced. So people weren't spending because people were worried and scared to spend, and people didn't have money to spend and nothing was being produced. So now we have nothing being produced, people aren't spending money, and then the government, with the help of the Federal Reserve Bank, printed trillions and trillions of dollars and gave it to people. Now people have money, but nothing is still being produced. So now that people have money, what did they do? Well, they went shopping. People bought groceries, they bought clothes, they bought things, and now you have this limited supply of clothes and stuff. I mean, I'm just going to give clothes as an example, but you have this limited supply of clothes because nothing is being produced and people are buying it. Now, when people are buying things with a limited supply, that's going to push the price of these things up because now there's nothing else to sell. So now you're selling out of these shirts, you're raising the prices of the shirts because you want to lower the demand because you have everybody trying to buy them. And now you have this backlog at the manufacturing plants because everyone is ordering more shirts, they're ordering more supplies because there's this huge demand for all these products. Well, everything was shut down. And then as things start to open back up, you have all these manufacturing plants and suppliers that are overloaded with orders. This is now the supply chain issues because now you have this manufacturing and supply chain that is so overburdened because you had all these people making orders, all these people buying things when there wasn't enough supply. Now you have the supply chain issues, which now the manufacturing plants need more money, the workers need more money, they have to hire more people, costs start to go up, and this then trickles down to the retail price of your shirts and whatever else you want to buy. The price of everything keeps going up with it. So the root cause of the inflation wasn't just that things shut down, because when things shut down, people weren't spending and things weren't being produced. It was when now things aren't being produced, but people now suddenly have the ability to spend more than ever, because what we saw was that people's incomes and wealth actually rose during the pandemic. Why? Because now you had either your income, but then you could also supplement that with unemployment checks and also stimulus checks, and also businesses were getting a ton of free money from the government. So now you had people, businesses, corporations, everybody who had so much money, so much ability to spend, people were buying like crazy, and now the demand goes through the roof while the supply is way down here, which then caused the bottlenecks in the supply chain, which then caused the price of things to go up. So there's definitely a root to inflation, which is one of those things that Jerome Powell never really talks about, but just one of those things where a difference in opinions on what causes inflation. Obviously, I have my own opinion, but this is where it's important for you to be financially educated, not just blindly trust a random guy on YouTube, but understand what causes the inflation. That way you can be better with your money. Because now that we're in this situation where now the Federal Reserve Bank is working to bring inflation down, the question is, what's going to happen? Because, well, we went through a lot of different phases. The first phase was that money printing is not going to cause any sort of inflation. The second phase was this inflation is transitory. The third phase is this inflation is going to not cause a recession. The fourth phase is if we do see a recession, it's going to be a soft landing. And this is where you can start to see where, there's been a lot of opinions about what happens with the money printing and what's actually going to happen in the economy. But this is where, instead of just blindly trusting anybody, whether it's the Federal Reserve Bank, the government, or a random guy on YouTube, you being financially educated and being financially prepared, that way you can protect yourself, you can protect your family, and you can protect your community against whatever happens, because at the end of the day, you want to be prepared for the worst. And if we do continue to see more economic declines, because it looks like the Federal Reserve Bank is going to continue raising interest rates. Higher interest rates slow down the economy. It slows down unemployment. I mean, historically, what we've also seen is that before you see an uptick in unemployment, you also see unemployment hit the bottom. So you see unemployment bottom, and then you see unemployment rise. We've seen that happen in most of the previous recessions. And so this is just understanding that if the Federal Reserve Bank is continuing to raise interest rates to slow down the economy, if the Federal Reserve Bank wants to continue to soften the labor market, aka have less jobs, if the Federal Reserve Bank wants to continue to lower demand, all these things are going to have an effect on the economy. And this is where, one, patience is important, but also financial education is important. That way you can make sure not only you can protect yourself, but also capitalize on opportunities that might come your way.